Thanks for joining us for this round of your quarterly breakdown of what's happening in the markets and the economy and everything associated there. So a couple real quick housekeeping items from me before we jump in. One, as with all of our webinars, please keep in mind that this content is meant for educational purposes. We're not giving investment advice here today. Also, if you like the content that YCharts creates, you like these webinars, the other pieces that our marketing team puts out, please don't hesitate to subscribe to our YouTube channel and keep an eye on everything else that our team puts out so you can get similar content along the way. You'll also notice as we go through the slides today, there will be a small QR code in the upper right corner of the screen. If at any point you're compelled to say, hey, want to take a trial of YCharts, scan that QR code and that'll make it really easy for you to do so. If you have questions as we go, please post them. Please do that using the Q&A function in the Zoom webinar. And Charlie and I will do our best to answer those potentially as we go and save some time at the end, which we sometimes struggle with, but we're going to do our best today. So,
fingers crossed. Yeah.
All right. So let's go ahead and get things started here. So, Charlie, thanks again for joining us. If anybody doesn't know, Charlie's the Chief Market Strategist over at Creative Planning. You should be following him on your socials at Charlie Bilello. Always great content, amazing use of charts, and always does an amazing job of telling the stories of what's happening in the market. So Charlie, thanks again for joining us today.
Yeah, absolutely. Thanks for having me, and thanks everyone for joining. We got a lot of good stuff to talk about.
Indeed. So quick rundown of what we'll cover. Top of everyone's mind, I'm sure, is this morning's inflation report. So Charlie's going to break that down and tell us what we should be paying attention to and what it means. We're going to spend some time talking about the Fed and what don't fight the Fed maybe means right now. We'll talk about how the first half of this year maybe didn't play out the way that a lot of us expected it to. Maybe a kind of positive surprise there. A little bit about happy workers and unhappy office owners. And lastly, it might be time to call it a comeback. So we'll get into that as well before we wrap up with some Q&A. But let's jump into our first topic. Charlie, we were chatting a little bit before we started here. A little bit of a surprise this morning with maybe some good news, right? So break it down for us.
Better than expected, for sure. And the expectation was for a big drop with CPI and was even lower than people had thought. The expectation was 3.1% and actually came in a little bit below 3%. So that's now 12 straight monthly declines in CPI. It peaked last June at 9.1%. We're below 3%. That's great news. The core rate, importantly, that excludes food and energy, that came down as well. So now that's below 5%. Certainly you want to see that continue to go down. But overall, a great report. It was expected to be good, but better than expected. And the market reacting pretty good as you might expect. Stocks hitting new 52-week highs across the board, S&P, NASDAQ. So a good report overall. And if you dig into the components, I think a lot of good things to take away. And if you just go back to last June, Caleb, and you remember that feeling of gas prices above $5 a gallon, you had commodity prices looking at corn and wheat and all food prices really accelerating to the upside. You had pretty much everything showing the highest rates of inflation that we've seen since the early 1980s. And you had the Fed obviously aggressively hiking rates. And now fast forward 12 months later, and nearly every single major category is showing a lower inflation rate than last June. And the only exception to that is shelter. And we've talked a little bit about shelter, but it's a weird animal in terms of CPI. It's very lagging in terms of an indicator. So if we look at actual rents, they are now down year over year. Actual home prices are down slightly year over year. So this shelter is still showing a 7.8% increase. But again, that's lagging. That's kind of taking into account the price increases that we saw last year and the year before and playing catch up. So everything else, lower rate of inflation. And importantly, you have a lot of negatives there. So not just a lot of people, when I post the inflation charts, they get mad at me on Twitter. They're saying, yeah, the rates come down, but overall prices going up. And that is true. But if we look at certain categories like gasoline, used cars, fuel oil, utilities, those are actually down from last year, right, on a nominal basis. So it's not just the slow rate of growth. If you dig into some of the components, they've come down as well. And the really big one, I think, for a lot of people is the grocery store. If you look at that food at home category, now below 5%. And Caleb, I don't know about you, but everyone was talking about buying chickens in January of this year when egg prices skyrocketed. They hit record highs. They were almost $5 for a dozen eggs. Great news now. Egg prices, if you look at a dozen eggs today, down around $2 for a dozen. So hopefully you didn't go out and buy chickens in January. You would take a little bit of a loss on those chickens.
I'm still on the chicken bandwagon, Charlie. Haven't pulled the trigger yet, but I like the idea, regardless of egg prices.
Yeah, well, now you can get them cheaper, so that's good.
All right. So love looking at the components. But I guess one thing that happened a week ago, I think it was about a week ago, we got the employment report. That number looked great. Market actually sold off to that report because I think the sentiment was this means the Fed's for sure going to continue their rate hikes. We now get this inflation report. Market reacts very positively to this good news. Is this a sign that that Fed policy may not be as impacted by the employment report that we got last week?
I don't know. Nothing really changed. It was interesting. After the report this morning, Fed fund futures are still pricing in another hike. So they're saying the Fed is going to do one more hike, and we'll talk about that a little bit more in the Fed section. But nothing really changed. Yes, employment remains strong. That probably gives the Fed more comfort in hiking again and saying they're not yet seeing employment weaken. And there's some people arguing that the Fed wants to see employment slow down or unemployment rate go up. I think that's utter nonsense. That doesn't make any sense. You want to see employment go up. And in many ways, that's going to help inflation. If you have more workers, that'll cool wage price inflation as well. So I'm not on that belief. But if we look at Fed policy here, Caleb, very interesting. We talked about this last year that these two lines were going to converge, right? The Fed funds rate and CPI. And here we are now, Fed funds rate above 5%, with the Fed expected to hike again in a few weeks at its July meeting, and CPI under 3%. So that spread there, and this is how I kind of quantify, is the Fed being tight? Is the Fed being easy? You can see that bottom panel of the chart there. Now we have a real Fed funds rate, so Fed funds rate minus CPI, over 2%. And the last time we saw a Fed funds rate minus CPI that high without the Fed funds rate being at zero, you got to go back to 2007, so August 2007. So it's been a long time of easy, ultra easy monetary policy. We haven't seen this in a long time. And we talked about this on the last webinar, but the question is, has there been a shift now in terms of the Fed's thinking, where are they now going to abandon that ultra easy policy and perhaps go back to a more normal monetary policy that we had before the financial crisis in 2008, where the Fed funds rate, during an expansion at least, would stay above CPI, right? And I think that's the big question. How long is it going to stay? But at least for the next few months, unless there's a crisis, it seems like the Fed's going to keep that tight policy in place.
I guess back to maybe the jobs report a little bit, but more good news. I think hourly earnings are finally starting to tick up as well, right? So not only are prices stabilizing, but people's earnings are starting to catch up.
This is the big one. This is the most important chart, and unfortunately, 25 straight months we had to report negative news where people's wages weren't keeping pace with rising prices. But now finally, wage growth is above 4%. We have inflation down to 3%. Well, now that's spread back in positive territory for 2 months in a row. And this is how we get back on that path to prosperity, right? It's just, you feel it. And that's why sentiment was so negative throughout last year. People were seeing prices go up way more than their wages, and they were worried that that was going to continue forever. Thankfully, it hasn't. We're now moving back in the other direction. Big factor driving that, we don't have a chart in there today, but we talked about it a lot during the last webinar, is that money supply continues to come down. So Fed, I think, has gotten the message. You need to have real wage growth be in positive territory, and they were going to hike, I think, until this got positive, which was my mantra. And now we're in positive, and they seem like they're going to hike again. But after that, I think if this stays positive, they'll feel more comfortable pausing in terms of policy. But certainly a good thing. We should all celebrate this. And I'm not of the opinion that wage growth needs to slow. Let wages continue to go up as long as they're above the rate of inflation. That's a very good thing for everyone.
So the way we interpret CPI usually is looking at changes year over year. And this most recent print showed I think a 3% increase year over year. But how much that changes year over year is largely dependent on what it was a year ago, right? So as we progress to months coming up, I think some of those changes may be a little bit, I guess, more difficult to keep at those low numbers. Is that how I'm interpreting this?
Absolutely. So the real test is going to begin next month, Caleb. So we saw just a huge surge in prices in the first half of 2022, and part of that was commodity driven. Russia invading Ukraine caused a huge spike higher in a lot of commodities. The back half of last year saw that cool off a lot. But what we're seeing in terms of the last few months is those big readings from last May and June dropping off, right? And they're being replaced with much lower numbers. So we see there May was a 0.1% increase and June 0.2% increase. Well, that 0.2% is replacing that 1.2%. And the math of that simply means that inflation rate, at least over the last year, has gone down to 3%. Now, yes, it's still, prices are still 3% higher. So on an overall basis, right, we've talked about some areas are down if we're looking at particularly commodities and gas prices and things like that. But overall, prices are still higher than a year ago. But the big question, I think, is going to be for that July number, are we going to start to see, let's say a resurgence? Is, the expectation on that bottom panel, that's from the Cleveland Fed. They're expecting CPI now to go up from 3.3% up to 3.6% when we get that July report, next month. But we don't know yet, right? If that's correct or not. It's going to be dependent on what the actual inflation is for July. And that's going to be the test the next few months. Is this, or the rate hikes, going to lead to, and I think they have already, a continued decline in demand, which is going to put a lid on prices. What's going to happen with commodities? Are we going to see a resurgence there? Is the shelter component, which is over a third of CPI, we're going to see that continue to decelerate in the months to come, or we're going to see a reacceleration there? All of those questions are unknown. So we don't know what inflation is going to look like in the back half of the year, but we know the easy comps are over, and now the real work, I guess, is going to begin. And depending on how much this rises in the next few months, that's going to be part of what dictates whether the Fed stays, after the next hike, stays at that level or feels like it needs to do a few more. So if we see CPI go back, let's say above 4%, start moving to 5% again, what are they going to do? They might have to come in and do more. But if we see it level off, let's say between 3 and 4%, maybe they're comfortable with that as long as they have that Fed funds rate above 5%. Still restrictive policy, right? So all that remains unknown. Just be aware that it's great news. CPI's come down to 3%, but there's still some more work to be done, particularly on the core side.
So what are some numbers you're looking for going forward that you would feel good about then, Charlie, if with knowing the comps that we'll be dealing with from a year ago?
In terms of saying what I think will remain low on a year-over-year basis, I think number one would be the shelter component, because it's such a lagging indicator that it's going to continue to come down. And we're seeing rents now down slightly, not a huge decline, but down slightly on a year-over-year basis. If you look at Redfin's data or apartment lists data, that's a good sign driving that. And Case Shiller's showing a slight decline in home prices over the last year. So again, that's all with a lag. So my expectation would be that would continue to come down. Used car prices, so we have a lot of good real-time data on that. That's kind of leveled off. It went up a little bit in the first few months of the year, but now is coming down again. I would expect that to continue to come down. I'm still waiting for that. That's big. One of my biggest surprises, why it hasn't come down even more. There's a lot of things driving that, but I would expect that to be a soft component. The commodities part, who knows? Like if the recession fears, and we'll talk about that in a little bit, that haven't materialized, if they start to become more front and center, well, that'll put a top on commodity prices. But if not, let's say recession is pushed out, perhaps commodities could go the other way. And if we look at food prices right now, things look good. That should continue to decelerate, and the big question I think for the Fed, and there's no real answer to this, is when kind of that wage push inflation will come down. When will the labor market really open up and not be as tight as it's been, and that will bring down wages and start to help in that area. That it remains to be seen. But the employment from last month is not really a huge sign. The number was lower, but still there seems to be more demand for labor in the coming months. So a lot of guesswork. I think let's just take it day by day. But certainly things are in a much better place than last June, and that's why obviously the market's in a much better place as well.
Well, good. So we don't know where inflation is going to be. We can certainly guess. Should we poll and find out what everybody thinks as far as the go forward number?
Absolutely. Yeah. Let's see this. And remember, this is important because a big part of inflation is our expectations. If we think inflation is going to be higher, we're willing to accept higher prices. So let's see what people think about inflation over the next year. We've had 3% over the last year. What's it going to be over the next year?
All right. So I think we've got someone on our team is going to throw that poll up for everybody.
Awesome.
So go ahead and respond to. There it is.
There we go.
All right. So we'll leave that up for a minute. As we do, and before we look at the results, I guess we'll transition to the next section, which is don't fight the Fed. Very, very common phrase. What does that mean right now?
Yeah. Don't fight the Fed. It's really fascinating because there's just an endless number of people telling you this, Caleb, right, throughout. Once you get in the investment business, it's kind of the first thing people hear, or they don't fight the Fed. And as soon as I heard that, it was interesting. I started to analyze the data and look at it. I said, could it be that simple that you just follow what the Fed does and that will lead you to that's a holy grail indicator by itself. But what does this saying mean? It essentially means if the Fed is easy and the monetary policy is easy, or they're cutting interest rates, and you want to be in the market, stocks are going to go up because the Fed wants it to go up, essentially. And the opposite, if the Fed is hiking rates or being tight in their monetary policy, well, the implication is get out of the market. And so that's kind of how the saying was built. And if we look at the last year, it's had 500 basis points of Fed hikes. So if there ever a time where you're going to use this saying, and people did, right? Don't fight the Fed. Don't fight the Fed. Every single month, the Fed is hiking rates very aggressively, the most aggressive rate hiking cycle since the early 1980s. And you would think this would have led to a huge stock market decline. It did last year, but if you look at where we are today, and we'll talk about that in a few slides, I think a lot of people would be surprised by what's actually transpired. And if we look at the historical data, it shouldn't actually be that surprising.
All right, let's look at the results of our poll here, if we can. All right, so I think most people are expecting maybe average to slightly lower inflation over the next year.
Yeah, that will be awesome. I would take would you take a 2% number over the next year?
I think that sounds great.
Yeah, so hopefully that's correct.
Be happy with that.
Yeah, very few people thinking 5%. Yeah, so hopefully that doesn't turn out, and these expectations will adjust as prices adjust. Right, the best indicator of future expectations on inflation is what inflation has just done. So if inflation stays low, expectations will stay low. But I think this is a good sign, and hopefully the crowd here is right.
I guess on the flip side, though, that may indicate that a very low or manageable number for inflation is kind of priced into the market right now going forward too.
No question. And if you look at market implied inflation expectations, they're around low 2% area. So the market's saying that. Yeah, if we look at this poll, people are saying that. So the surprise would be if that doesn't happen, and then you have another problem on your hands. But if we look at the Fed here, Caleb, what the market is saying is 500 basis points was not enough. They're going to do one more in July in 2 weeks. They're going to hike to 5.25 to 5.5%. That's going to be the highest since '07. And but after that, if we look at the expectation curve, things have really shifted a lot since we last spoke. Is that the next chart? I believe it is. Yes. So the last time we spoke, the market was saying the Fed was going to stop where it is today, and essentially no more hikes. And they did pause in June, but if you look at the recent minutes and you looked at their projections, the Fed actually said in their June meeting that they were going to hike 2 more times this year if you look at their expectations. And so far, the market's believing one of those hikes, but not the other. But you can see they're kind of a big shift in terms of expectations from rate cuts expected in the back half of 2023 to now rate cuts are not expected until 2024. So really the new mantra is higher for longer. How much longer? We don't know. These change all the time. As we said on the last time we got together, take this all with a grain of salt because it changes with every single data point. Every time the Fed makes a speech or they have a meeting, these can change wildly. And I expect by the next time we're speaking, they're going to change again. But at least for now, the market's expectation is higher for longer. And the last time we spoke, Caleb, we said, well, that if that actually happens, that could be interpreted one of 2 ways. One would be negative. Let's say if the reason the Fed was doing it was inflation data was bad over the last few months. A positive would be that recessionary fears and data points have been pushed back. And so far it's been the latter. And so the market's kind of embracing that, and good news is good news, at least for today. The market's saying, well, it's fine to have a Fed funds rate higher if it means that the expansion is going to continue for a little bit longer.
Charlie, in regards to the Fed's policy, interesting question from one of our attendees today. Do you think next year being an election year will affect the Fed's policy and shifted it all away from the way that they've been reacting to data, more recently?
I don't believe so. I mean, I've accused the Fed of being political, but not in the way that they're trying to change the outcome of an election. If you look at the last few election cycles, the Fed didn't really not act or act based on that, right? So I don't think this time will be any different. I think if they need to hike or more, they'll do so. If they don't, I don't believe it will have a huge impact. I know a lot of people will say otherwise, but hopefully they won't. They're supposed to be independent. They should do what they have to do. But we've seen time and time again where the Fed has acted during election years in 2008. Right? I guess the question would be, I always ask as well, what there has to be, I guess, an implication of who they want to win, and how a certain policy would help that president, I guess. Right ahead of that, and you have to, so if let's say they want the party in power to stay in power, they want Democrats to stay in power, would that mean them aggressively cutting rates next year, even though it's not warranted? Or let's say they want them out of power, would that mean, I guess that the implication would be they would keep rates higher or push rates higher? I don't see either one of those. I'm not, as you know, a big fan of the Fed setting interest rates to begin with. I don't think they do a particularly good job with it. I think the market would be a much better arbiter of where interest rates should be. But I think that if the Fed feels like it needs to do either a hike or cuts next year, I don't think that the election is going to be a big factor.
All right. So you also looked at where the Fed funds rate was and what that meant for go forward S&P 500 returns. What'd you find here?
And this is the important one, because once you dig into the data, and this is what I meant when I first heard that saying, I'm like, let's test it. Let's let's see if this is real. This is something tradable. This is something actionable, or almost all of what the Fed is saying, essentially, at least when it comes to predicting how the market's going to do, is noise. And what this chart is showing is two different things. In the top panel, it's showing you different Fed funds rate from lowest to highest, broken down by quintiles, and then what the S&P 500 has done over the next year, 3 years, 5 years, 10 years on average. And the bottom panel is showing you, well, is the Fed easy or tight? And the top there is ultra easy, so negative real Fed funds rate, which we've seen in the past decade a lot of that, all the way up to very tight policy, where the Fed's funds rate is well above the CPI. And what jumps out at you, Caleb, when you look at a chart like this?
Well, I'm thinking back to that chart we looked at, maybe 5-10 minutes ago, that said it's now sitting right around that just over 2%. And
yep,
that row seems the worst. So that's what caught my eye down there on the bottom half.
Yes, it's just right.
But everything is very
but
positive.
Go just below that.
Yeah, the trend breakdown.
Just below that is even tighter, and the market has done the best following that. So, but I think what you were saying before I interrupted you was that everything is green, everything is up. So regardless of where the Fed is, the market's usually higher a year later. And when the Fed has had its highest Fed funds rate ever, so looking like above 7%, forward S&P 500 returns have been the best if we're looking out 5-10 years from now. And that's even true if we're looking at how tight they are, easy they are. We're the fifth quintile, the highest real Fed funds rate. We've seen the best returns. So something else is driving the market clearly other than Fed funds rate. Maybe it's valuations. That's a big part of it, right? A lot of the periods where the Fed funds rate was very high and high in a real rate was during the early 1980s. And guess what happened after that? The stock market boomed, right? So you can't say with any certainty what the S&P 500 is going to do if you knew the Fed funds rate and nothing else. It's really almost impossible. So this notion, don't fight the Fed, just absolutely throw it out. Sometimes it's true that the Fed hikes rates and the markets go down, but most of the time, on average, the market is up regardless of what the Fed is doing.
I guess
here we go. Right, surprise, right? And this is just I updated this today. Fed started hiking rates March 16th, 2022. They finally lifted rates off of zero. We were screaming all throughout 2021. They weren't listening to us. Why isn't the Fed hiking rates? Well, they finally got the message in March of 2022. Stocks did correct, right? Had a pretty sizable correction, 27% down to its low in October. But look at where it is now. It's actually 3% higher, the S&P 500, than when the Fed started hiking rates. And they've hiked 500 basis points, and they're expected to continue to hike in a few weeks. So what do you do the question then is, what do you do with that don't fight the Fed mantra at this point? If all of last year you were like, yeah, don't fight the Fed, it's working. But really, as we talked about, and we'll talk about again later, the odds actually favored taking a more aggressive stance in the market based on those declines, not looking at the Fed at all. But here we are now. Clearly, the market is more than just the Fed if the 500 basis points higher and stocks are higher, right?
Do you think differently about that statement when it comes to the fixed income portion of your portfolio?
Oh, for sure. Yeah. In terms of what bonds will do. Yeah, exactly. For sure. Especially, Caleb, when they're coming off of historic lows, right? When 10 years at 1% and the Fed is starting to hike rates and you have high inflation, oh, now you got a problem for bonds. So and we were talking about it at the time, saying, be very careful with duration. A very small move higher in interest rates is going to be a game changer. And it's really interesting that bonds are still, I think, about 13%. If we look at the Bloomberg Ag Index, 13% below its high, and the S&P on a total return basis is now, I think, only 3 or 4% below its prior high. So, so far, bond market yeah, the S&P's decline last year was bigger, but so far, looking at it cumulatively, bond market has been hit much higher. But we're in a different place now, even in terms of bonds, right? Because bond yields have reset. And so from here, even if interest rates were to continue to go up, now you have a cushion. And we're seeing that already this year, right? The Fed's continue to hike rates, it hasn't had as big of an impact, even with yields starting to rise the last few weeks, because you're getting that higher coupon. You're not starting at 1%, you're starting at 4% if you're looking at the 10-year. If you're looking at the shorter term, like 1 year, you're well over 5%, right? So those like shorter maturity treasury securities, much better position today to withstand interest rate hikes. So yes, good question. Very different animal, stocks and bonds.
I guess back to the stock market though. Just if the Fed starts cutting rates, that's not necessarily a good sign to go super long equities, huh?
A lot of people are telling me that the Fed needs to cut rates here. That they've hiked them too high. They shouldn't keep hiking. They got to cut, and their reasoning for that is usually we want the stock market to go higher. Let's just cut rates. And yes, that maybe that would be helpful, all else equal. But all else is never equal. And usually, when the Fed's aggressively cutting interest rates, it's not a very good thing. It's because things are pretty bad. And if we look at the last two major bear markets, so 2000 to 2002 and 2007 to 2009, you could see that blue line there, the light blue line, stocks are going down, and the other darker blue line, well, what is the Fed doing? They're cutting rates the entire time. So stocks went down over 50% in both of those bear markets, and almost the entire time the Fed is cutting rates. They cut rates to 1% during the 2000 to 2002 bear market, and they cut rates down to 0 in the 07 to 09 bear market. And yes, there was a bottom at some point, and stocks did start going higher. But if you notice, the interesting thing following the early 2000s bear market, the stock market started going up, and the Fed did what it always did, which is start normalizing policy, and that didn't prevent a bull market there. There was a bull market from the bottom in 02 to the peak in 2007, and the Fed is hiking interest rates, right? So, and that's common. We've seen that throughout history. The Fed eases policy during contractions. They tighten policy during expansions when inflation's starting to be a problem. The weird thing is after 2008, we didn't see that. And the Fed took 7 years to start to normalize policy. They waited till 2015. And so I think people kind of got addicted to that easy money thing, and they saw how much stocks went up over that period from 2009 and the next decade. And the Fed was very easy during that decade. So they forgot the history before that point and said, easy money is good, not easy money is bad. But you have to look at the full data set. And I think they're maybe starting to learn that today. And I say, if you want lower interest rates and you want that because you want stocks to go higher, be careful what you wish for.
So YCharts also did a little bit of proprietary research, I guess, to look at what happens with different asset classes during these rate hike cycles. And I think the thing that jumps out at me here is nothing's consistent. A lot of colors kind of spread all over the place. But how did you interpret some of our results?
That was my exact conclusion. You look at this. You look at it was a great report. Everyone should check it out. But the real takeaway was that even if you knew when a hiking cycle was going to occur, let's say you knew all of these hiking cycles in advance, and you were trying to position your portfolio in a certain way, we couldn't really do that because every different cycle had a different leader, a different lagger. Before the 3 prior hiking cycles to this one, if you look at the S&P 500, they're positive, 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 and now the research team at YCharts is, I think, going to have to update this if the Fed does indeed hike again in 2 weeks. And lo and behold, we're going to be probably looking at another positive for the S&P 500. So you can't necessarily predict, obviously, that the stocks are going to be down. That hasn't, we showed that chart. And then as for other asset class, very difficult as well. Even if you're looking at things like commodities, yes, sometimes they do really well. Sometimes they don't. And if we look at bonds, it's not a clear cut. We know bonds have not done well during this hiking cycle, but in prior hiking cycle, the one before that, bonds did okay, right? So every cycle is different, and that's a takeaway, not just from following the Fed, just markets in general, right? There's no predictable pattern to market behavior in terms of this has happened. This is going to happen in the future. Let's say you had a crystal ball, and then you could say with any type of certainty what different asset classes are going to be. And then the conclusion from that, Caleb, is, well, I need to be diversified then. If I don't know what's going to do well in different regimes, then the best answer typically for most investors is to own everything, to diversify.
Indeed. Yeah, and we've actually talked about updating this data after the next hike, and excited to see what that looks like. And I mean, the whole concept of don't fight the Fed, I mean, this was in our research too. And, a similar conclusion about being long equities during rate hike cycles does not seem like a bad idea.
Well, usually, right, if you think it's kind of intuitive, because if the Fed is hiking rates, it's not always the case that they're doing it to curb inflation. Certainly they were last year, but many other cycles they're hiking rates because economic growth is strengthening, and that's a good thing, right? And then earnings thereby should be doing better, right? And over any long period of time, if we exclude kind of the late 1970s, early 1980s period, and last year, over a longer period of time, if the Fed is keeping rates high, it's probably because the economy is doing okay, and you don't want to then see like a cut in rates. So it's not necessarily intuitive, but rising interest rates historically haven't been bad for stocks. Actually, stocks have done better if you look at periods where the 10-year yield is rising than when the 10-year yield is falling. I think that would surprise a lot of people.
And speaking of when the economy's stronger or strong, if I go back, a couple webinars ago, I think we polled everybody on whether or not there'd be a recession or if we were in a recession. And I think almost half of the audience was a little bit bearish, about where we were in the economy, and thinking that if we weren't already in a recession, we probably would be soon. A lot of us.
I think it was even higher than that, if I remember. Yeah, it could have been higher. Yeah.
So what happened?
Yeah. Everybody was wrong. The crowd was wrong. Most people thought a recession was going to happen this year. If you look at Strategist, Economist, and we saw coming into the year, we saw strategists for the first time in decades were actually predicting a down year for stocks in 2023. And what does the market like to do? It likes to cause the most pain to the most participants. And what we saw in the first half was a lot of pain if you were thinking the market's going to be down this year and betting that way. We had one of the best first halves that we've seen in a long time, since 2019. But before that, you got to go back to 1997. S&P up close to 16%, even more if you include dividends. And what went wrong in terms of the economic projections? A lot of things, but I guess the biggest one was the continued strength in the labor market. And I think that can't be overstated how important this is to the U.S. economy. We actually saw the U.S. unemployment rate on the right side there hit its lowest levels since 1969. And so that happened in the first half of the year. You're clearly not going to have a recession when you have that type of data. We've had now 30 consecutive months of payroll growth in the U.S. And the labor market has loosened, but the expectation seems to be there's still a gap between what companies need and the available supply. So the expectation is we're going to see a few more months of wage growth and of labor growth, and that's going to continue to keep the U.S. economy out of a recession. Now, how long? Nobody knows. But for now, most people are pushing back their recession calls into either fourth quarter this year or early next year.
And volatility is kind of melting away too, right?
Yeah, just as big of a surprise here, maybe even bigger after the year we had last year. We talked about last year, the VIX spiking above 30 a bunch of times. It didn't get as high as it did during 2020. I mean, nothing has historically. That was the highest levels we ever saw for the VIX, but much higher than normal volatility last year. If we look at the number of days where the S&P was down 3% or even 2%, just big swings back and forth. And that hasn't continued. We've seen kind of that wall of worry that was built up last year from Fed policy tightening, from interest rates rising, from those recession fears, from earnings, S&P 500 earnings going down last year, and just all of these fears built up last year, one by one, have kind of been torn down. And if we look at the inflation picture, right, we talked about how that has improved. We look at Fed policy. Yes, they've tightened a few more times, but now they're expected to be close to the end of the hiking cycle. That has people feeling good. And if we look at the attitude about earnings, well, that's improved because earnings have been much better than people expected. So the wall of worry is down. I don't think anyone thought the VIX would be below 13.
But we knew the housing market couldn't stay strong.
So this one got me for sure. I did not think that the housing market would be this resilient. I certainly thought we'd see bigger price declines this year. I mean, coming into this year, we had really the lowest affordability on record, worse than the last housing bubble. And big reason for that was home prices went up 40% in a few years, and mortgage rates went from under 3% to 7%. So if you're in the market for a home and you're doing the math, well, most people can't afford that home. And so I assumed, and it did happen for a few months, I assumed, well, prices have to come down to make them more affordable. But a strange thing happened that I didn't anticipate, is that people who had already purchased their home, let's say in 2019, 2020, 2021, and maybe even before that, and they have this mortgage rate below 4%, and some people below 3%. Well, those people did not want to move. They had this extremely low rate. You have inflation, and that's good for existing debt, right? Your wages are going up. You have that fixed mortgage rate. Well, that's a great thing. And the math of it, if those people wanted to go then and buy another home and get a new mortgage, it doesn't work, because you're at 7% versus the 3% rate you have, and you're going to get much less house. So what's happened so far is we've seen just a rapid decline in supply, and the demand has come down, but because the supply has come down so much, you're just seeing prices kind of flatline here. They're down a little bit year over year. Certainly it's regional as well, as we talk about, but just looking at this chart here, you can see population, if we go back to 1985, I think this is where it goes back to, with the U.S. population below 240 million. Now we're above 330 million. And you look at that existing home inventory, how low it is today compared to decades ago when the population, it's just, you can start to understand why, why prices aren't moving. You don't have that supply. The supply demand equation is in balance, I guess. And, is this going to last forever? I don't think so. But for now, it certainly has been a surprise to me.
Yeah. I mean, it's interesting. Like, a lot of the supply on this chart is illustrated by existing homes. Do you think a lot of new housing starts and seeing more supply from the new side could start to have an impact there?
Yes. So yeah, good point. We saw last month a huge spike in housing starts. We've been seeing the home builder sentiment go up every single month. We got the home builder home construction ETF hitting a new high this year, recovering. Talk about surprises, recovering all of its losses from last year. And so that is kind of pricing in more supply to come. So yes, but it takes some time to build for homes to be built. So this could take some time. But if we're looking at like the share of homes inventory that's coming from new homes, it's at the highest levels it's ever been. So there's a few things you're saying, so the question I always ask is, well, where are the people getting the money that can afford these houses if clearly it's not affordable based on mortgage rates? Well, we're seeing a spike in cash buyers. So I guess if you have cash, doesn't matter what the mortgage rate is. That's a good position to be in. Exactly. Or it's people, I guess, that have so much equity built up in their home that they don't, that's enough to put a bigger down payment in terms of that new home. So, but it's just a fascinating thing to see. The best thing that could happen for America is a lot more new homes to be built. So there's, even without this picture in terms of the mortgage rates, there was a deficit of homes for sure. After the financial crisis, we just saw housing starts collapse, and they very slowly recovered from there. And just if you look at household formation versus new homes that are being built, there's a lag of at least a few million. So we have to close that gap. And looks like for now, builders are building, and if you build it, Caleb, they will come.
All right, so
feel the dreams.
Of course. So I guess looking at some stocks, or what parts of the market have actually performed well this year, maybe some surprises here too.
Yeah, did you pick Nvidia to be number one?
I didn't. I wish I did. I also wasn't all over the cruise lines either, but
yeah. So the big thing driving this, that I don't know anyone. I wish someone would have told me that ChatGPT was going to be a craze, and I know you've used it, and anyone out there who's listening who hasn't should definitely check it out. But not only was it the first app to hit 100 million users, like the quickest ever, but it just led to this kind of market resurgence and market euphoria, with people saying, not just ChatGPT, but you're going to have the supplier of these AI programs, like semiconductors, are benefiting. Nvidia supposedly has 80 to 90% share of that market right now, so it's considered to be the biggest beneficiary. But stocks like Facebook, Meta, there you can see number two. Just a number of huge tech companies going up and benefiting from this. The idea is that Amazon, Apple, Google, they're all going to be winners in this AI revolution. So something that was not on my list was another mania this quick after this is not the same as the mania in early 2021. That was definitely with IPOs and SPACs and meme stocks. That was a different class, and I don't think we'll see that again, perhaps for a long time. But in terms of big tech enthusiasm, we're almost right there, and that's a huge surprise, with Nvidia back at new highs, Apple, Microsoft, a lot of the big leaders coming right back to new highs.
All right, let's jump ahead here. I guess interesting talk track. Everybody's been thinking about this, whether it's affecting you as a worker or as an investor. But we've got some cool data to share here that you put together on kind of the difference between where worker mentalities are and where office attendance is.
So this is a cool one to see. Conference Board does this poll asking people, how satisfied you are in your job. Are you satisfied? And this year we saw the highest satisfaction rate in the survey's history. And they dug in a little bit in terms of what's driving that. And there was two big factors. Number one is that people like the new flexibility of being able to work from home at least a few days a week. It doesn't have to be every day, but for most people, they got that. That was the one good thing I like to say that happened during the 2020, as a result of 2020, was that we saw that for many jobs, obviously not every job, but many jobs that are technology related or information related, you can work from home. And we saw productivity from people, and people are happy about that, especially if you have young kids. It's a huge factor. Your commute time is down, right? So you're not wasting that time commuting in and out of your office. And people like that flexibility. So that drove this satisfaction survey higher. The second big reason, do I have it on the second chart here?
Check here.
Let's see. Yes. So the second big reason was people left jobs they didn't like, or they were able to leave jobs they didn't like and pursue jobs that they did like. And the reason where they were able to do that, number one, stimulus obviously helped. Number two was you have this unbelievable number of job openings, right? So you had, this spike in job openings relative to people that are unemployed. So if we look at things like the quit rate, surged to a record high. So people quitting their jobs that they don't like, moving to positions that they do like. And all that is great to see, right? It's great for the worker. In my view, a happier worker is a more productive worker. So That's an absolutely good thing. But who is it not good for? Well, I think you could probably guess. These office buildings, right, where the companies weren't built assuming we were going to see this rapid of a transition, right? So if we look at occupancy in terms of major metro areas, I think a national average is still 50% below pre-pandemic level. So it's come back, and it's coming back slowly, and you're hearing more companies push for people to be back in the office, but most places aren't going back to an everyday model, and maybe they never will, right? And so that's a big shift for commercial real estate, for office. They're obviously, as these they tend to be long leases, and as those leases start to expire, well, you don't need as much space if you're not going to have people there every day. And that's starting to hit the commercial real estate sector. If we look at just the biggest office REITs out there, they haven't recovered like the S&P has. And the reason for that is vacancy rates are at the highest levels since the early 1990s. And we have the three, I think, biggest, I put in a chart, three biggest equity office REITs down 40 to 50% since Jan 2022 versus S&P down. Now it's less than 5% after today. So a big question, Caleb, is there's a lot of good news we talked about today, and certainly we should celebrate that. But is this potentially something that markets are not paying enough attention to? Is this the canary in the coal mine, so to speak?
And I guess before we get into our next chart, our last poll when we did a webinar was around the banking crisis that was happening that everyone maybe forgot about. People thought their deposits were safe. Happy to say, I think a little north of 80% of our attendees were feeling pretty confident in the banks and their deposits. But
yes,
this all kind of ties together with these regional banks and their exposure.
No question. Who owns the bulk of commercial real estate loans and office loans in general? Well, many regional banks. And I'm not saying that's why it's down this much. Certainly part of the reason. The other reason, of course, is what happened with those three bank failures. But if we look at the market as a whole here, if we look at the NASDAQ 100, S&P 500, you could clearly see for now they could care less about this issue. I can't remember the last time someone talked about regional banks. It certainly hasn't been it's over a month, maybe 2 months now, how quickly that went from being a crisis. And we said at the time, if most people have the FDIC insured, like, don't worry, you don't have to worry about your deposit, certainly. And they bailed out everyone above that level anyway so far. But so far, I'd say this is still an issue. It's still kind of hanging over there, but the market is saying for now, no impact. And so this would be something in the back half. Let's say more delinquencies continue to rise, and they should. Like, I can't see that office situation reverting back or getting closer to being a better situation, ironically, until employment gets worse, right? So when maybe in the next recession, whenever it comes, companies will start pushing more to have their employees back in the office. And as the labor market tightens, perhaps that will cause a little bit more. But I think overall, this is kind of a paradigm shift where we're not going back to the old model because it's working so well, right? Why would you go back to it?
Sure. All right, moving on to our last section, talking about a market comeback. We're calling it a comeback. It's official. Charlie says it. So, but yeah, I guess the contrast here of looking at the prior 6-month return and kind of what we've seen since.
So this was a chart we showed a bunch of times last year, particularly at the end of June, end of September. We saw one of the worst 6-month periods for the total market, the Wilshire 5000, than we've seen in a long time. And I just listed the top 20. And what we said back then was, who knows what's going to happen in the next few months, or even 6 months, or even a year. The odds go in your favor. But if you're looking out 5-10 years, all of these worst month periods, pretty good returns, well above the average from all periods. Right? So you're most of the time as an investor, you're better off being a net buyer, right, of this fear than obviously panicking, right? And we have some results so far, and the market's up 19% from that June reading. We don't have a year yet on the September reading, but likely to be up as well. And that's the upside of downside, is you have this fear that creates opportunity. And we'll see this again. It's coming again. We don't know when, but yeah, now you're armed with the data. You can think a little bit more rationally when the next time it happens.
Different view, I guess, looking at just year by year and asset class, right?
Polar opposite, right, of 2022, which 2022 was the polar opposite of 2021. So is 2024 going to be the polar opposite again? Who knows? But it shows you how fickle market participants can be, right, in terms of their sentiment. They went from loving crypto to hating it to loving it again. Same thing with tech stocks, and on and on down the list. I mean, this year, almost everything's positive. There's one thing in red there you could see, commodities, and that people are happy about, most people, because that means inflation is lower, right? So it's really been a rising tide that's lifted all boats, and we'll see what happens from here. But I caution people, obviously, a 40% return from the NASDAQ 100 6 months is not normal. Don't think that rate of appreciation is likely to continue.
But the buzzword everybody's been hearing now is it's a bull market, right? And I think that gets people feeling good and excited about the markets. What does that mean? We've transitioned into a bull market. Does that mean it's a bad time to be a buyer, a good time to be a buyer?
Well, it's interesting, Caleb. Like we want to be descriptive. We want to describe what's going on. So we come up with these terms, bull and bear, and most people just say it's 20% decline, you're in a bear. And then I guess at some point, if it rallies 20%, then the bear market's over, I guess, and you have a new bull market. To me, throw these terms out. Like as an investor, they're not helpful at all, because they're just telling you what's happened in hindsight. It would have been helpful to know a new bull market was starting last October, but we didn't know that then. All we knew was that sentiment was bad, the market's down a lot, and it's a better time to buy than the peak in January 2022. That's all we knew. We didn't know if it was going to go down more, how much more, anything. We certainly didn't think, or I don't think many people said we were going to have a 28% rally. But now calling that a bull market at this point, well, how's that helpful? It's only helpful if that suggests that the market's going to continue to go up, but we don't know, right? If let's say tomorrow it peaks and starts going down again, or it goes down 20, would you be shocked if that happened? I wouldn't. So I just it's less than helpful kind of saying it's a bull or a bear. It's only helpful if you knew what was going to happen in the future. But this is a pretty big rally. We saw rallies like this in the 07, 09 bear market, but they were brief. They didn't go on for this long. Same thing in 2000 and 2002. We saw huge rallies, but they didn't last this long. So we're kind of diverging from prior bear markets. That has a lot of people excited, but to me, even that doesn't tell you very much, because every bear market's different, and every bull market too. So great to see that stocks are higher, but for me, I was much more optimistic when we had this video going on in October of last year than I am today. So I'm maybe a strange animal. When the market goes up, I'm less bullish. The market goes down, I'm more bullish. That's really the opposite of what most people think.
It's the old, I guess, Warren Buffett mentality, right? Fear and greed.
Fear and greed, they drive everything. And most people are greedy when others are greedy, and fearful when others are fearful. And do we have a chart on sentiment? I think
yes. It is.
And here we are. Market prices are higher, 28% higher. And guess what? People are bullish again. So this is a spread between bulls and bears. So last year we saw one of the lowest spreads ever in terms of bears outnumbering bulls, and now this isn't extreme by any means. We'll see. I think we get another reading tomorrow, but we're certainly now pushing up on the upper end of things, and it's just fascinating to see because if you look at, I think today's Prime Day, right? Did you get anything for Prime Day yet?
I don't want to disclose that.
Okay. Okay.
We made a couple purchases yesterday.
Good man. Yes, you're helping. You're doing your part.
That's right. I'm doing
economy.
my part for the economy.
Now I'm guessing what got you, part of what got you to buy something on that particular day was a pretty good discount, right?
Of course.
And yeah, like why else would you need to do that day? Same thing as Black Friday when. I've never done this, but you see every year, right? They have this footage of people fighting themselves to get into stores to get the low price on the latest TV or whatever electronic, right? People rush in to buy stuff when it comes to consumer goods when there's a good discount, right? And the stock market, it's the complete opposite. When prices go down, people literally are running out of the store. They're going in the opposite direction, and when prices go up, they're like, "Hey, this is great. Let's buy some more." So it's a very strange animal, the stock market. But yes, all else equal, you want to be doing the opposite. Now, it doesn't mean that because sentiment is better now, necessarily the market's going to go down. So you have to be very careful with that, with playing that type of game. It just means it's not as good as when sentiment was in the tank last year. So extreme bullish sentiment is not nearly the same thing as extreme bearish sentiment.
All right. Well, I think that's our last chart. I know we're a couple minutes over the hour, but Charlie, do you have time to take a couple quick questions?
Yes, absolutely. Right. Let's bring it on.
All right. We've got a lot here. Let me scroll through here. I know we had one, and I know this is one you like to touch on, every time around the yield curve and looking, at the spread between the 10-year and the 2-year. How are you thinking about that right now? And how do you think that might affect interest rates going forward?
Yeah, it's still there, right? That inversion, that little pesky inversion. And what we talked about last year when the yield curve first inverted is this is kind of a weird animal because usually there's a pretty sizable lag between the inversion and the start of a recession. And so we were like, well, we just got 2 quarters of negative GDP. Did we get the economy peak before the inversion this time? Is a weird, but in hindsight now, that little dip we had in GDP was not considered an official recession by any means. I think the employment numbers and growth since then has kind of proven that. I don't know what you want to call it, but they're not calling it a recession. But I would say the indicator is not invalidated by any means because it's A, it's still there. B, this is well within the range of historically, you don't typically see a recession yet. So if we look at the 3-month versus 10-year, which is something I like even better than 2 and 10s, that inverted last October. So we're not even at a year yet. And most of the recessions have occurred over a year after that inversion. So it's not invalidated. It just shows you that there's absolutely no timing mechanism built into that. And from a stock market perspective, pretty sure we said last year, it's not really actionable because the stock market is its own animal around the economy. You don't know. The stock market often is also itself a leading indicator, but you don't know when it's going to peak ahead of a market, an economic downturn. So it's something I'm still watching. I don't think it's too early to say, it just didn't happen this time. And that's kind of the case with these long leading indicators. You have to see. I still think that rates being restrictive, and if we look at housing activity, we look at auto loans where they are, we look at credit card rates above 20%. I still think that so-called long and variable lag to Fed policy, I still think we're not yet seeing the full effect of that. And so it's hard to appreciate because yes, the economy is still growing, but I think it's only a matter of time before that starts to take a toll. And perhaps that's what the market's still saying. We're just not there yet, right? So
do you think if the Fed stops hiking, that curve will start to retake a normal shape again pretty quickly?
Yeah. It'll end when the Fed shifts gears, right? When the Fed says, the economy's starting to go down, they're going to start cutting that short end aggressively, right? And they did that in September 2007. The cycle before that, they started it in early 2001, right? So once they see, perhaps it'll be the employment number. I don't know what particular metric they're going to be looking at, but once they see that, yield curve's going to steepen aggressively very quickly, right? And at that point, it'll actually be like confirmation, like here is the recession. So it's not the inversion itself that tells you we're in a recession. Usually, when you get to that recessionary point, well, the Fed is starting to ease aggressively, and the yield curve starts to normalize. So that, by then it's, I guess, too late. But that'll be the signal that you want to pay attention to, that aggressive steepening in the yield curve.
Yeah. All right, let's take one more, and then we'll do our best to answer the rest of these, offline. But somebody asked about a pending credit event, in quotes, that they're hearing could affect the markets. Does that term mean anything to you?
Well, yeah, I mean, certainly a credit event would be a bad thing. We had that with, I think, the banks, right? We're seeing more bankruptcies. If you looking at just, we're seeing the highest number of bankruptcies we've seen in years. What we're not seeing, I would say, in terms of credit markets, and this is something I follow very closely, is credit spreads, and we're seeing it in CMBS, so we're seeing it in anything related to commercial real estate in terms of spreads widening. That's definitely saying there's going to be many credit events in the commercial real estate sector in the next year or two. You're going to see much higher default rates going forward, particularly in that office market, right? And that's coming. I think that's for sure. We don't know yet how the market's going to react to it. For now, they're saying, oh, it doesn't matter. Perhaps they'll change that. But if we're looking at broad, like high yield credit spreads, they're kind of still just saying it's not there yet. There's not any concern that I'm seeing looking at high yield spreads or investment grade spreads to say there's going to be like a broad increase in default cycle, in that space. So last year, that was one of the things when we were kind of looking at recessionary indicators. The one thing that was missing was that significant increase in credit spreads. The bond market was right. Like that part of the bond market was right. Like the so-called smart money, they actually got it right. Now that can change very quickly. We've seen that before, so I'll still continue to watch that. But for now, overall, we're not seeing those higher interest rates. We're not seeing that impact corporations, where we're seeing a big problem. So I think people would have expected it to happen more already, Caleb, right? Given the interest rate shocks, right? And just the amount of leverage that was in the system, and kind of trying to participate in the mania. What do? You use leverage, and that was all over the place. And 500 basis points doesn't seem to be enough so far to cause widespread, or just it hasn't happened yet. So yeah, for sure.
Leverage is much less attractive to take on now with higher yields. So
yeah, that's another factor as well, right? But I guess all that takes time, and for now, people are feeling good, and who's to say that can't continue? I certainly can't say it. I'm just less bullish today than when the market was 20%.
Just looking for buying opportunities, Charlie. You're just looking for value.
Sure, absolutely.
All right. Well, thank you so much for joining us again. I know this is always a lot of fun for me, and we get great feedback from those that attend too. So appreciate it. Looking forward to next time. I'll be following everything you post between now and then. But thanks a lot, Charlie.
Awesome. Thank you, Caleb. Thanks everyone for joining, and yeah, have a great summer, and hopefully all the news stays good throughout the rest of the summer. We have a nice quiet summer.
That sounds great. All right. Bye, everybody. Thank you for joining us today. Thanks, Charlie.
Thanks. Take care.